Hello, and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's panelists are Mark Bowman, our Global Markets Specialist, Alan Bush, our Senior Financial Economist, and Mark Soderberg, our Senior Ag Market Specialist. Starting with the soft market today, Mark Bowman, how does the West African cocoa crop look?
Well, last week there were some unofficial reports calling for a 40% drop in Ivory Coast mid-crop production from last year. This is based on pod counts and kind of anecdotal commentary or research commentary from various analysts and traders. They're blaming the extended hot and dry conditions in February, March. We've got talking about small pods and just flowers at this point and fewer larger pods. So, this suggests that at very least, it's going to get off to a slow start. Now, it looks like Ivory Coast, Ghana will get some rain this week, and Nigeria and Cameroon next week, which will help at least boost production further along in the season, but still does not get us past that 40% decline overall. We've seen Ivory Coast port arrivals this week around 13,000 tons, which is down slightly from 14,000 last week. Cumulative arrivals now for 24-25. Which began in October, now 1.4 million tons versus 1.284 million a year ago, and below the 5-year average of 1.596 million. This is still the second lowest cumulative number in at least 6 years. Now, arrivals have a tendency to start to pick up this time of year, so the next few weeks could be the tell on how much damage has been done to the mid-crop.
And what is the implication for the global supply-demand balance?
Okay, so at the end of February, ICCO put out their quarterly supply-demand outlook, and they forecasted a balance for 2024-25 at 142,000 metric tons. It's a surplus. This follows 3 straight years of deficits. Last year's deficit was 441,000. Now, this surplus is almost equal parts increased supply and reduced demand. They got production up 351,000 tons this year and grind down 235,000. First quarter grind numbers, I want to add that also, how much of this 142,000 surplus is reflected in this idea that we're going to have a poor mid-crop. Certainly they knew going in that the dry conditions this year would have caused that. Now, first quarter grind numbers due out April 17th. That will be for Europe, North America, and Asia. And that this could be the next indication of how severely demand was affected by the high prices this past year. For the 2024 calendar year, Europe's grind was down 1.7% from the previous year. Asia's was up 0.1%, virtually unchanged, and North America's was up 4%.
All right, Mark. Moving over to the ags, Mark Soderberg, with a major USDA report next Monday. Are there any historical tendencies ahead of next week's data?
Yeah, Jeannie, I've always felt that the end of the March quarterly stocks and acreage report was really, in terms of importance and impact on price, one of the top 2 or 3 reports from the USDA in any given calendar year. This year, the market is bracing for a rather sizable 3 to 4 million acreage shift away from soybeans into corn, while also a little bit of a higher lean in wheat acres as well. In the February outlook, the USDA, they had 94 million acres plugged in on their corn balance sheets. That was up 3.4 million from a year ago. Bean acres at 84 million. That was down just over 3 million from last year. So right now, it just doesn't appear that the average estimate will change a whole lot here. If there are any surprises to the surveyed responses from U.S. farmers, I lean towards perhaps not as many acres shifted away from corn and into soybeans as expected. Historically, there's been a bit of a bullish tilt out of this report for corn. In the last 25 years, prices have closed higher on report day 16 times, or about 65% of the time, while closing lower 35% of the time. In wheat, it's also a little bit of a friendly lean as well, closing higher 14 times, down 10 times, while unchanged once. And beans is pretty much of an even 50-50 proposition, down 13 times, up only 12 in the last 25 years. And once this data is out, it's largely going to come down to Mother Nature and determining what the final spring plantings acreage mix will look like.
All right. As the market's attention gradually shifts to the U.S. growing season, anything on your radar in terms of South American production?
Yeah, a couple of things stand out. First off, bean harvest in Brazil is starting to hit the home stretch there this week. AgRuel, they've reported that 77% of the crop was now harvested. That's slightly above the historical average. They also lowered their production forecast 2.3 million metric tons to just below 166 million metric tons. It's still a record high crop, but it is now fair amount below the USDA forecast at 169. For the past few months, it seemed like the USDA estimate was too low. However, some late season dryness, particularly across the south, seems to be taking its toll on the later developing crops. As a result, most private guesses are now coming in just below the USDA forecast. And staying in Brazil, the second corn crop, it appears to be in largely very good shape for a good portion of the crop. Biggest worry right now is still in the southern growing regions and southern parts of Paraná and southern Sao Paulo. However, this typically only accounts for about 15% of that second corn crop. In Argentina, harvest is still in its pretty early stages, kind of an up and down growing season. It's not going to be a record yielding crop, but however, nowhere near the disaster we had 3 years ago when the drought significantly cut production there. My guess is the current USDA forecast, 50 million metric tons in corn, 49 million metric tons for beans, are probably a little bit high. Finishing weather will feature cooler temperatures this week and a few more scattered, a couple more widespread rain events. However, I think this will likely slow harvest more than anything else, have very limited benefit for the late maturing crops down there.
Thanks, Mark. And finally, over to Alan Bush. Alan, what is the significance of the gap higher openings for the S&P 500, NASDAQ, and Dow Jones futures?
Okay, well, first of all, yes, we did have gap higher openings for those three stock index futures, S&P, NASDAQ, and Dow, gapping higher today and remaining above downtrend lines. In fact, further extending advances from breakouts to the upside about 2 weeks ago. So this is definitely a technical sign of strength. So these gaps suggest that there may be a major change in the fundamentals coming. Now, currently, it appears that traders are anticipating new U.S. tariffs set to take effect on April 2nd, which could be softer and more targeted than initially anticipated. Also, we had President Donald Trump suggesting on Friday that there could be, in his word, flexibility in the plan, while weekend reports indicated that the tariffs may be narrower in scope and could potentially spare some industries. So on the tariff situation, things might be improving a bit, this being reflected in current pricing in stock index futures. Also, in addition, recent gains are linked to increasing prospects of a more accommodative federal open market committee. Also, my analysis suggests that the Fed may be cutting its key rate, its Fed funds rate, 2 or 3 times this year, with the first reduction likely at the June meeting. So these gaps higher in stock index futures suggesting the fundamentals are improving. And I think these gaps are likely to be continuation gaps or breakaway gaps, not exhaustion gaps. Exhaustion gaps often take place at the end of a move. So I think this is a situation where these gaps should be construed as continuation or breakaway, suggesting higher prices, at least in the near term, are likely for the indices.
All right. And last question, Alan. What major economic reports are scheduled for this week?
Okay, Wednesday we have durable goods, and they're expected to be down 1%. And then on Thursday, fourth quarter final GDP expected to be up 2.4%.
All right. I appreciate all your time today, everybody. And remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, please visit admis.com. Thank you.